let's move on to another strategy. Let's get back to a passive loss limitations. Okay, so let's use a case study. Someone, a taxpayer, investor, making $100,000 or less. Okay, not more than 150K. Okay, let's look at the IRS active investor rule. Okay, adjusted gross income of, let's say, 100 grand. Well, most of our investors located in California, they make a lot more than $100,000 a year. Okay, but some make less than 100 grand. We have members who live outside California, right? I have members within my investment club who some live in Arizona, some live in Texas, some live in Florida, some live in the East Coast. Yeah, I would say 80% of my investment network members live in California. I live in San Francisco Bay Area for the past 30 years, which is one of the highest cost of living area in the world for that matter. So that's why you and I invest out of state.
Exactly. I was going to say that's why 80% of your clients are in California because it's too expensive to invest here. So we have to go out of state to do that.
Absolutely. Yeah, I've been doing it for 20 years. So I've been there, done that. I see a lot of new flavors of real estate come and go, but my investment methodology have not changed for 20 years. Buy turnkey properties out of state with professional management and long distance remotely, and let everybody else do the dirty work for you so you can grow your portfolio, so you can free up time to travel, to do whatever is important to you, and not get bogged down for those daily aspects of self-management, which is whatever. Okay, the problem is, getting back to the tax rule, Section 469 of the IRS tax code limits losses from passive activities from offsetting non-passive income. So again, our income property, which is fine, even though you and I are not getting special tax benefit, at least we're getting all the other dimensions, cash flow appreciation and whatever, which we just talked about. By definition, long-term investors using professional management, you and I, any kind of depreciation or paper loss can only offset by the passive income, by the rental income limitation that we collect. So we cannot use our depreciation passive losses as passive real estate investors against W-2, which is non-passive, which is active income. So far, so good?
Yes.
Yeah. The exception is you qualify for reps. Reps, be prepared to bring this acronym into your terminology. Reps means real estate professional status, which we will talk about toward the back end of this video presentation. But people think, oh, real estate professional status, you must be a real estate agent, you must be a realtor. No, you don't have. Real estate professional status is a IRS definition. It's not a real estate definition. Okay, you don't have to be a licensed realtor. You don't have to become a real estate investor. You don't have to be whatever. We'll talk about more about that. So full-time employees and full-time business owners cannot qualify as a real estate professional because one of the qualifications is spend more time in real estate than anything else. Anyway, we'll talk more about that later on. Okay, let's continue. So here's the passive loss limitation. Julie, I'm sure in your past, you learned something about this, right? When you were in the business of real estate years ago. So, yeah, so passive loss allowance, again, if you make $100,000 just gross income, you could only reduce your debt service expenses from your rental property and any depreciation you get up to the maximum of $25,000, which is my deal. But again, later on, we could talk about briefly the real estate professional status. You get unlimited write-off. That's the key. Not too many people are willing and are able to qualify as a real estate professional status. Again, we'll talk more about that later. But it's okay, because if you make less than 100 grand, you can deduct up to $25,000 property, the passive losses, paper losses, against your active income. Yeah. So 25,000. So if you do use a straight line, 27.5-year annual depreciation on a property like $200,000 property, for example, that you and I buy, $200,000 per property divided by 27.5 year, which is the depreciation method. So the annual depreciation is probably like 5,000. So if you buy 5 $200,000 long-term rental properties at $5,000 annual paper depreciation loss, based on this rule, so basically 5 rental properties of a 200 grand pretty much max you at the $25,000 passive loss depreciation limitation
I see.
under this category. So far, so good.
That makes sense.
Good thing about it, people, when people watch this video and they can archive this video, they can always replay
There you
any
go.
of the words that come out of my mouth. Okay.
Mhm.
And you may not be able to digest any of this presentation immediately, but the
Right.
beauty of having this video available for future purposes, you can replay the video, whatever areas of this video that you need to further understand.
Sure, absolutely.
Anyway, so the next level of passive loss allowance limitation are people that make more than 100 grand, but less than $150,000 adjusted gross income. As a passive real estate investor, most of us are, you get no current year deduction. All the depreciation and passive losses have to be suspended indefinitely for future years to offset against future passive income. Does it make sense so far?
Yes, I understand what you're saying. Okay.
Yeah. But then again, some people, like most of our investors, Julie, are from California, they make way more than 150K. So one would think that, oh, I should not buy real estate because I'm not getting any current year depreciation deduction to offset my passive, my rental income. That is a very limited belief, which is uncalled for. So let's get educated. I'm gonna prove the point that you can still buy income property regardless of the tax benefit, because your primary goal is to get cash flow and appreciation and loan pay down, and
Right.
now you're
Right.
all right. Now the key is, if you make more than 150K, great, you pay a lot of taxes, great. If you make 300K, 500, $500,000, stay tuned toward the back end of this presentation. I'm going to blow your mind with the huge tax benefits if you qualify. Julie?
Okay, that sounds good.
So 150K or higher, you have to, any depreciation you could potentially claim or carry forward in the future years, suspension of passive losses. You're going to accumulate a lot of passive losses into the future years to potentially have a future tax benefit. If you make a lot of money per these limitations, it's okay. It's okay to, because your future suspended accumulation of passive losses, depreciation, you cannot get on the current year, that's a future benefit. So keep that in mind, especially when you're a long-term risk investor. So those benefits will come back to you. Okay.
That makes sense.
Yeah. Don't fear. All right. Let's go on. Yeah. Okay. This slide should pretty much talk about the passive loss limitation. Do you have any questions about the passive loss limitation? Any quick comment, Yuli?
It makes a lot of sense. But again, I think it's just looking at this whole concept as a long-term strategy, not looking to get all the benefits today or within the first year. So yeah, that does make a lot of sense to understand that at some point in the future, you'll be able to take advantage of those losses, those passive losses.
Absolutely. Yeah. Especially when you sell, if you were to sell some of the property in the future, some of your rentals in the future, any capital gains you could trigger can be offset by those accumulation of suspended past losses.
That's good to know.
Whereby your capital gains is potentially substantially reduced or even eliminated. Whereas you do not need to do a 1031 taxable exchange.
Oh, that is good to know. I don't think I realized that. I thought you always had to do a 1031 exchange in order to avoid that tax liability. Oh, wow. That is good to know.
That's one tax tip you just learned, Julie.
I did. That's very important.
If I were to tell you, a lot of investors I come across over my several decades of real estate consulting, that a lot of investors who've been investing for 5, 10, 15 years, a lot of the tax strategies we are discussing today, they are not totally aware.
That's a good piece. I didn't know that. Yeah.
They don't know. They still don't know. See, you think a savvy investor who bought 2 or 3 rental properties for the past 5 years, you think they know it all?
Probably not. Definitely not.
They do not know at all. In fact, they know a lot less than they lead out to believe.
There you go.
Why?
Mhm.
Because I consult with those individuals
Mhm.
on
Mhm.
on a daily, weekly, monthly basis. I've helped so many hundreds and even
Mhm.
thousands of risk investors. And I know the challenges they're facing. They
Mhm.
don't know at all. In fact, they know a lot
Right.
less. Think they know.
Yeah, exactly. Exactly.
Yeah.
That's interesting.
That's right. I'm telling you from real experience. We're gonna use this pro forma template to do the numbers. So this property is a property that we promote in South Texas. This
Yes.
fourplex new construction, this 4-unit duplex quad, fourplex, 45K. I'm not gonna go over the numbers, but this is a great cash flow property, good rent to value ratio, the whole 9 yards. So we're gonna use this as a template to go over the case study of various tax strategies. Okay, keep that
Right.
in mind. This is the benchmark we're using. We could be using any type of property. Not doesn't have to be fourplex. It could be a duplex, could be a triplex, could be a single family home unit. So just bear in mind this is the template we're using. So let's calculate regular depreciation. Okay, this property 545K. You minus a land is not depreciable. Let's say 20% of your property is land. So you have to take out the land out of it. So you go your basis for depreciation, your cost
Right.
basis, if you will, is 436,000. So
Mhm.
far, so good?
You're right. That makes sense. Yes.
Yeah. Most people, even so-called savvy risk investors, they think the only way you can capture the paper loss to reduce the gross rental
Mhm.
income on each property or the straight line depreciation for 1 to 4 unit, which is 27. You depreciate little by little over 27
Mhm.
and a half years on a residential income property. On a
Mhm.
commercial 5 unit or above, the depreciation straight line schedule is 39 years. All right, so far
Oh,
so good?
okay. Yes, that makes sense.
Yeah.
Mhm.
So on this fourplex, so 436 divided by 27 and a half years. So your annual depreciation, your paper
Mhm.
loss that the
Right.
tax code allow you to achieve to reduce your income subject to taxation is almost 16 grand. So that's a
Right.
nice benefit just from one fourplex for 545K, right?
That's it. That's
So
nice. Yeah,
yeah,
definitely.
yeah, that's really nice. Using, like I
Mhm.
said, you could file on a Schedule E, okay, in supplemental income schedule, regular straight line 27 and a half year depreciation schedule. And I took the liberty of doing some calculation. This is the Schedule E, right? Income and loss, Schedule E from 1040. So this is the gross rental income on that fourplex, right?
Mhm.
So even you can still, if you cannot get the depreciation because you make more than 150K, you can still deduct all this, you can still deduct all this debt service and all these monthly and
Right.
annual
There you go.
expenses from the
That's
gross
right.
income.
Mhm.
Because Julie, the gross is 64,000. You're collecting the rent for the year on this
That's
fourplex,
right.
right?
That's right.
If you do not take any deduction, any of these underlying deductions down here,
Mhm.
the this 64,800 is
Mhm.
taxed at the ordinary tax bracket.
Okay. Okay.
Ordinary tax bracket, which is if in the upper end of your tax bracket at whatever the federal tax bracket like 37%, right?
Mhm.
Imagine if you make 400K, 500K W2 income,
Mhm.
4,000. If you ignore all these expenses down here,
Right.
you have to pay 37 federal and maybe 13% state income tax
Mhm.
in California or
Absolutely.
New York State.
Absolutely. Yes.
Half of this $64,000 will be the IRS can collect half of it.
Yes. Mhm.
Okay,
They sure are.
but you are a smart investor. You watch our video. You watch this particular video. So you take your regular debt service expenses,
Mhm.
advertising, travel expenses, cleaning and maintenance, your insurance you pay on your rental property, your property management fee, and this annual amount, all this annual, by the way, the mortgage interest you pay on income property, all deductible against the rental income, against the
Right.
gross rent,
Right.
right? And so on. And then on top of that, based on the prior example, you on this fourplex, you're getting almost $16,000 of paper loss
Mhm.
on a year-over-year basis for the next 27 and a half years.
Right.
Therefore, so your total expenses on this one property, this quad, is 76,000 already, and your rent for the year is 64,000. But on the real aspect is you get cash flow, right?
Oh, absolutely.
The
Yeah.
cash flow, you the reality purposes, you're collecting cash flow, which is right here. Your monthly
Right.
cash flow is
Woo.
773.
Almost $800 a month.
Your annual net cash flow almost 10 grand, right?
That's a good deal.
So in reality, you are making money just
Absolutely.
based on cash flow, but you're making money on appreciation also, which is not taxable because you're not selling your property.
Right.
So this is a unrealized equity gain year over year based on the projected first year appreciation and beyond, right?
Absolutely. Oh, that's
So,
fabulous.
so,
That's a
so
great property.
yeah, in reality, you're making 10 grand net annual cash flow. And yet on paper, because you understand tax strategies and all that, on paper, you show a loss. You show a paper loss, right? Of 76,000. So 64,000 gross annual rent on this one property, minus 76,000 of all the deductions and depreciation and all that equals your paper loss of almost $12,000.
Right.
On paper, when
Yes.
you file your federal tax return the following April 15th or beyond, if you're doing an extension, this 11,922 on just one property can reduce your adjusted gross income accordingly. So if you think about it, Julie, if your adjusted gross income, let's say 100 grand, okay, with this deduction of paper passive loss was almost 12 grand. Are you paying taxes on 100 grand or you paying taxes on $89,000? So this deduction will give you a lot of tax benefit. Okay.
Absolutely.
Yeah.
It's amazing.
Yeah. We could talk cost segregation later. We could, and we could talk real estate professionals tax status later on this presentation. Okay. So far, so good.
No, this is great. This is really good information.
Am I explaining this in a layman's way where you truly
Absolutely. I don't do my own taxes, but it's really simple. When you look at it on the paper, you can definitely see the advantage. And I think the point that you made is you are still collecting the rent, which is giving you cash flow. But then on paper, then you have these losses that can be carried out through the years. So it's a great strategy.
Amazing. And